Welcome to ME 342 Foundations of Finance. This is chapter number 7. Okay. All right. Tonight we're going to be talking about stock. Okay. Evaluation of financial asset is actually equity or stock. There are many different types of stocks. You have preferred stock, which is a hybrid security. It is similar to bonds with fixed dividends amount, similar to common stock as dividends are not required and have no fixed maturity. Now, common stock is what everybody talks about majority of the time. It's open out to the market after initial public offering or IPO. A company issues it out to raise money. Common stock have a voting option, so every year they get to elect the board of directors, which is very important because the board of directors actually hires the CEO of the company. You want a competent board of directors because the CEO controls all functions of the organization. Okay. Some preferred stock features, they have a par value or face value of the stock or the bond. They have accumulative earnings. Any preferred dividends are not paid in the previous year must be paid before common dividends can be distributed. So if you think about it, preferred comes first. So just like if a company was to file bankruptcy, the preferred stockholders are going to get their money before the common stockholders. Okay. They have maturity. There's generally no specific maturity date, priority to assets and earnings. Dividends must be paid on preferred stocks before they can be paid on common stocks. Almost all preferred stock is a non-voting stock, okay? Which is you're going to pay more for preferred stock, but you don't get to vote, okay? Versus the common stock. They have convertibility. Preferred stock that can be converted to common stock at the option of the investor. Okay. Other provisions, they have a call provision, giving the issuing corporation the right to call in the preferred stock for redemption. Sinking funds call for the repurchase and retirement of a given percentage of stock each year. Participants with the common stock in sharing the firm's earnings. Okay. Common stocks, they have a par value, legally representing a stockholder's minimum financial obligation in the event the corporation is liquidated. They also get paid dividends. The firm has no legal obligation to pay common stock dividends. One company that has been made famous by not paying dividends but actually doing stock splits that everybody knows is Apple. Apple doesn't pay dividends. They have stock splits which actually give you more shares in the company every time they do a stock split, and then as the stock price rises, it gives you more value within the company. Okay. Common stock features, they generally have no specific maturity date. Dividends can be paid only after interest on debt and preferred dividends are paid. So again, if the company is liquidated, the common stock holders get their money last. Okay. They do have a voting right. Again, they get to elect directors and vote on the shareholders' proposals, mergers, changes in the company's charter or goals or missions. They have preemptive rights, give stockholders the right to purchase any additional shares of stock sold by the firm on a pro rata basis before the shares can be offered to new investors. So it's not first come, first serve. It's the stockholders who have the right or who've already invested in the company to buy the first stock, okay? Then you have types of stock. You have classified stock, which is a common stock that is given a specific destination, such as class A, B, C, etc., to meet special needs for the companies. You have the founder's share, a class of stock owned by the firm's founders who have sole voting rights in the early after going public. So these are the people who actually built the company up. They have founder stocks, okay? Equity instruments in international markets. You have the American Depository Receipts. It certifies created by banks and represent ownership in stocks and foreign companies. You have foreign equity. You have the Yankee stock and the Euro stock. Okay. Stock evaluation. These are the terms that we will be going over constantly. We have PO or P, the actual market price of the stock today. We have P of A, the expected price at the end of the year. PO, the current intrinsic value as seen by the investor. Then we have the price expected at the end of year one. We also have dividends, which we have the dividend the investor expects to receive at the end of the year. You have DO, which is the most recent dividend already paid. You have D1, which is the next dividend expected to be paid, and it will be paid at the end of this year. Okay. Growth rate is the expected rate of change in dividends per share. You have the required rate of return. This is the minimum rate of return on a common stock that the stockholders consider acceptable given its riskiness and returns available on other investments. Okay? These are the formulas that you will be using while evaluating stock. Okay? We have the current dividend formula, which is the current dividend parentheses 1 plus growth in parentheses divided by the rate of return minus growth. Then we have the next dividend formula, which is the dividend divided by, in parentheses, rate of return minus growth. This is very, very important. Growth is always going to be less than the required rate of return. If you have a growth that is, if you put into the formula a higher G than R, you're not going to get the right answer. It's going to come out incorrect. Let's look at a problem. I need you to find the stock price given that the current dividend is $2 per share. Dividends are expected to grow at a rate of 6% in the foreseeable future, and the required rate of return is 12%. Which formula does that sound like? It says the current dividend, so we're going to use the very first formula, the current dividend formula. So we're going to take the $2, then in parentheses, 1 plus the growth rate of 6% divided by the required rate of return minus the growth percent. And you should come up with $35.33. Easy peasy. The last dividend, okay, on Spirex's Corporation common stock was $4, and the expected growth rate is 10%. If you require a rate of $20%, what is the highest price you should be willing to pay for this stock? So again, we're talking about the last dividend, right? So that's the current dividend formula. We put it into the current dividend formula. 4% is our dividend. 1 plus the growth rate divided by required rate of return minus growth, $44. Is the expected price we should expect to pay for this stock. Let's assume that XYZ company intends to pay a $1 dividend per share next year, and you expect this to increase by 5% per year thereafter. Let's further assume your required rate of return on XYZ company stock is 10%. Currently, XYZ company stock is trading at $10 per share. Using the formula above, calculate the intrinsic value of 1 share of the XYZ company stock. Well, we already know we're talking about next year. So this is the next dividend formula. Sorry? So that's going to be the dividend divided by growth minus, this is going to be required rate of return minus growth, and this should be selling for $20, okay? But let's go back to the problem. It is currently trading at $10 per share. So according to the problem, it is worth $20 per share, but it's trading at $10. So that means that the stock is undervalued. Okay, so, but what are some of the things that make a stock trade for less than it's actually worth? They could be going through a change in management. the changing environment, that something is going on within the company that's making the actual price of the stock go down, okay? NewCo paid a 25-cent annual dividend in 2005 and expects to pay 26.5 cents in 2005, assuming a growth rate of 6% and required rate of return of 10%. Calculate the value of NewCo stock. I know what you're wondering. Is this a current or is it a future? Well, if you think about it, when you're doing something in life, do you want to look backwards or do you want to look forward? So when they're talking about they're expecting to pay, right, you'd always want to go with the next dividend formula. So if we put that into the next dividend formula, we have the dividend, which is 26.5 cents, divided by our required rate of return of 10% minus its growth rate, 6%. The value of the stock right now is $6.63. Okay. Let's talk about dividend yield and capital gains. Okay. We might need to figure out what is our required rate of return on a stock. We take our existing formula that we have and we switch it around. We now have the required rate of return equals dividend divided by price plus the growth rate. And that will give us our required rate of return. We also know that our dividend yield would be dividend divided by price. And our capital gain is just our growth rate. Alpha Preferred stock currently has a market price equal to $80 per share. If the dividend paid on this stock is $6 per share, what is the required rate of return investors are demanding from Alpha's preferred stock? We're going to use this formula. However, it didn't give us a growth rate, but we still can put it in the formula. We know that required rate of return is the dividend divided by the price plus growth rate. If it doesn't have a growth rate will be 0. So we'll take the 6 divided by 80, 7.5% is our required rate of return. Okay? If dividend is $3 and the price is $50 and the expected price at T1 is equal to 52, what are the stock's expected dividend yield, capital gains yield, and total return for the coming year? We have everything that we need to know to figure out the problem. Okay? We know that the expected dividend, okay, we're going to take the $3 divided by our price with $50, so the expected dividend yield is going to be 6%. Okay? Our expected capital gains yield is our future price minus our current price and then divided by future price, 4%. Our total expected return, you add both of these together, 10%. Okay? A stock is expected to pay a dividend of $2 at the end of the year. The required rate of return is 12%. What should be the stock price be if the growth rate is 4%? We've done this problem before. We know that D1 is 2. We know the growth rate is 4. Required rate of return is 12. Stock price is $25. Okay? A stock is expected to pay a dividend of $2 at the end of the year. The required rate of return is 12%. What should be the stock price be if the growth rate were 0%? $16.67. We still use the D1 formula, except we have 0 growth. And that is the end of Chapter 7.